Okay, let's take a look at the fundamentals for Apple here using gurufocus.com. And if you want to take a look at this for yourself, please look at the link in the description below and you can have a look for yourself at this page. So here we have the main page for Apple. And obviously, as you probably know, the largest company by market capitalization, almost $1 trillion. And that's just unbelievable. So let's look at a few of the numbers here. I always like to take a look at the warning signs that Guru Focus gives us here at the top of the page, and there are a few to look at: severe warning signs, medium warning signs, and there's one good sign. So let's just click, and it'll take us to their page for those, and we can go through each one. There are a few more than usual here, but severe ones are what I want to take a look at first. So declining gross margin. So this could be a sign of a company that's slowly declining in certain ways. Obviously, it deserves a lot more research, but we can click on the link and see that gross margins, okay, they've dipped below 40%. Over the past 10 years, they've sort of hovered between high 30s and low 40s. I don't think this is too alarming right off the top of my head. So maybe they're getting squeezed for price, or there are a lot of other factors that can go into this. But still, high 30s is a very good gross margin. So that one deserves a little more research. You can click on the button here and see where or how it compares and what the calculation is. But if you go back to 1996 here, obviously the low, a lot has changed in the history of Apple since then, but generally an increasing trend line, sort of going down over the past 5 years since 2012. So that is something that deserves a little more research, but let's just take a look at some of the other warning signs. We have a decline in operating margin. So those could be very well related. Here again, we see over the past 10 years, it's hovered low to high 20s, low to mid 30s, and just over 30 in 2015, down to 26.76. So kind of fluctuated, but I don't see an alarming drop in the operating margin. So we can go into the numbers here, take a look at the calculation, and see what's going on here. So here we can see the actual graph of that number over the years on a quarterly basis and an annual basis. So these are the calculations as well. If you're looking at operating income divided by revenue, that gives you your operating margin. And then you can decide whether or not that's a problem for you if you were to invest in this company. So the third severe warning sign is telling us that asset growth is faster than revenue growth. So, okay, let's find out what that's all about. It says if a company builds asset at 15.5% a year faster than its revenue growth rate of 14% over the past 5 years, it says it might mean that the company is getting less efficient. Those don't seem like alarming numbers, but here you can see the 10-year history of total assets. And obviously, if you look into Apple a little bit more, a lot of this is going to be cash that it has been saving over the years. So we can look at total assets here. Not an alarming trend, to be honest. So obviously, a company that holds a lot of cash that's not a problem. That's not a real problem that I'm worried about as far as a company that I'm investing in. I do want to see some innovation, but if it's saving cash and not being reckless with that cash, I would prefer to see that than to try to get rid of it. So anyway, that is where you can see some of the calculations that go into the total assets. So obviously, like I mentioned, a lot of cash on the balance sheet. And so I don't see that as a huge problem. If we do see revenue decline more, then obviously that is a problem with Apple. They need to sell their iPhones. So we'll keep an eye on that. Under the medium warning signs, we can see the dividend yield is close to a 5-year low. And right away, I think that would just relate more to the fact that the stock price is almost at its high, the highest it's ever been. So I don't know if that's a problem. I think it's a very healthy and consistent dividend, but obviously that deserves more research. Dividend yield, you can see, is about 1.5%, and that doesn't seem alarming to me. So it's sort of been steady over the past number of years for that dividend. So price close to a 10-year high. Yes, if you're looking at price alone, it is going up, but so are the rest of the positive fundamentals, things like revenue and earnings and things like that. As long as those all grow in line, and I believe Apple's growth prospects are still very good, then that shouldn't be a problem if you want to hold on to this company for a while. But it does say that it's at a 10-year high, and you can just see that on the chart here. So that's a 5-year chart. Fairly consistent, a little bit of a dip in 2015, 2016, and that was a good point to buy in the summer of 2016 there. So let's move to the price to sales ratio. So the PS ratio is a great one that I like to follow quite a bit. And of course, it just deals with revenue. So it's a fairly straightforward ratio. It's saying that it's at a 5-year high. And again, that relates to price. So if the price is at almost an all-time high, then that could be an issue, but also the company is growing. So it just means it's not as discounted as it has been in the past, but it's still maybe a very good investment for the future. And I would relate this as well to the severe warning sign over here that's telling us that revenue growth is not keeping up with asset growth. So we do want Apple to keep selling their products. And the PS ratio here you can see has hovered between high 3s, around 4, and low or mid, just above mid 2s for that 2015, where it was at a bit of a discount, and today 3.5. So I wouldn't see that as being too alarming, but it's nice to look at the trend. Actually, I'll show you that right now. When you go to the interactive chart, we can make this a 10-year chart. So this is just showing price, and let's look at the median price to sales ratio over the past 10 years. So what would the price be if it were at a consistent price to sales ratio? And it tells us right up here, it's at about just under 3.5 is the average over the past 10 years. And so not below the graph, a little bit obscured there, but it's around a 160 would have been the median price to sale, a price at this price to sales ratio. So if you believe that it's going to stay consistent with its average over time, then you may not want to buy at the highs right now. You may want to wait till it dips below. And as I said here, summer of 2016 was a great time to buy Apple, and many people did and held on for almost 100% gain there. So let's take a look again back at our warning signs. That's the price to sales ratio. And our last one for medium warning signs is that it is issuing new debt. So let's see what that's all about. And immediately I think to the cash that Apple holds. So I'm not worried that Apple is a company at risk of being held down by its debt because it does have a lot of cash on hand. But they have found it to be cheaper to borrow than it is to pay income tax by repatriating their cash. So anyway, that's a separate debate, but I don't think this is a debt-burdened company. They have just found it to be cheaper to issue debt than to use their cash in this instance. So anyway, you can see their long-term debt and capital lease obligation is close to $100 billion there, or sorry, $100 billion. So This is defined by debt due more than 12 months in the future. So that's not short-term debt. And it gives you a little bit of an explanation. You can click here on the link to see a little bit more about it and where it's gone up. So here you can see 2013 is where this started to go up. And that's probably in line with when their cash savings were going up. So I'd have to take a look at that chart separately and into the filings, but that's just what I suspect happened because they still were continuing to pay the dividend and to grow their business. And so, yeah, that's where you can look into some of those calculations. And there was a good sign that I'd like to take a look at. So right at the bottom here, one good sign, revenue per share shows consistent growth. And this one relates to the star rating system up here. So Guru Focus gives it a 2.5 star rating as far as predictability. So consistent. And we can see this graph shows us a fairly constant upward graph in revenue per share here, almost $43.65 per share in revenue. So that's a very good number. People would obviously like to continue to see that go up. And you can read all kinds of predictions on that. But obviously, revenue. So that's just the top line sales. And it's showing some very good consistency. So that is pretty much it for the warning signs that I'm seeing today for Apple. And good sign right there. I do love Apple. It's a great company that has a very strong brand, very, very strong product ecosystem. People love it. And lots to like about Apple. So something to keep in mind if you want to watch the value and buy this business. I don't think you can go wrong. All right, so take a look again at the link in the description if you want to look into this a little bit more. There's a lot of information in here, and that's about it for now. Okay, thanks. Bye for now.